Well, that's our signature tune, and today it's Sean Peche of Ranmore Funds. Well, Sean, we're not going on any offensives here. You're not going to be giving us some insight about performance fees and stuff like that. Man, you really have done huge contributions for the BizNews community, not just on performance fees, because now there are lots of people actually watching and seeing what it's costing them. But you told us at the conference to buy 2 shares. You told us to buy something called Core Civic, which, in fact, that was your favorite one at the conference. I can almost guarantee you no one in the room knew what Core Civic was. Since putting it in the BizNews portfolio, I checked this morning, it's up 23%. And you also told us to buy Total Energies. Since putting it in the BizNews performance, that one portfolio, that's up 29%. So quite apart from saving us money, you're making us money too. Well done, man.
Thanks, Alec. Look, you don't get it all right, and that's always the worry. So I think I just told you what I had in the portfolio. I didn't recommend anything specifically, but you might have seen actually on Twitter last night. Every quarter in the US, they release 13F filings. So if you have more than $100 million in the US invested, you have to release what you've got. And Michael Burry of the Big Short, fame, actually a couple of weeks ago, he sold everything other than a prison company. Of course, he owned the other prison company that's listed. But yesterday, it was disclosed that he's actually even been buying Core Civic. So who knows? It's you've got annuity income, long-term contracts, recession. The company's got buybacks. They're doing buybacks. So maybe it's a safe place to be. But I'm delighted that it's helped, and so that's good. And hopefully, you sold some tech stocks to make way for it.
And we also sold the NASDAQ ETF to put into the value fund ETF. And my goodness, that's been a big change. So thank you. What I should have done, though, was said to you, Sean, here's our portfolio. Just give us what you think. But I guess that would take the fun out of it. Then it'll be just because I also had a look on Morningstar.
Yeah.
And Ranmore Funds is now, you're shooting the lights out over the last 2 years, 1 percentile. In other words, 1 out of 100. Now, the only other time I remember this was when there's a South African who runs a Cederberg fund that they invested in China, and they were in the top number 1 percentile. I've never seen this before. That over the last 2 years, that's extraordinary.
Well, no, thanks, Alec. It has been great. And, that's the latest Morningstar data that we've seen. It's in the peer group. And it's top percentile year to date over the last 1 and 2 years. And I think it speaks to the fact that we're so different to everybody else. We just value investors. We don't care about the benchmark. We're going to buy what we think makes sense. And you will have seen so far this year, tech has been a disaster. And many of these growth companies have fallen on hard times, and we've dodged that. So we've managed to do that, even though we took a hit from Russian equities. And so hopefully that just speaks to our process and the merits of making sure that we worry about the margin of safety and the downside, because that's a big element. If you don't lose too much and you can compound the gains, that's important. You don't want to go down too far, because if you go down 25%, you've got to go up 33 to get back to where you were. If you go down 50, you've got to go up 100 to get back to where you were. So minimizing the drawdowns is very important, and that's critical, an essential part of our process.
Drawdowns, that's a very interesting word that I've now heard many people use. In other words, the falls in the share price.
Falls, yeah.
You did actually tell us at the conference, because I pushed you at the conference, and I said to you, what would be the one stock you recommend? And you said Core Civic. Now, you're going to be at the next BizNews conference, which we are, incidentally, only making once a year. So we're moving it from next year, February, end of February, beginning of March, coming out from the UK again. You're going to be talking to us again, and I hope you're doing your homework already to find another Core Civic for us. But is it likely, Sean, when these things turn, when momentum or growth stocks move to value stocks, does it last for a while? Because clearly that is where we are right now.
Well, if value has underperformed growth since 2007. So anybody who thinks this is going to be over in a couple of months, I think is mistaken. These markets move in long cycles. And so I think we're at the very beginning. And I think what's interesting, we last spoke on the 3rd of October. I had a look at my diary. And if you recall at the time, sentiment was very negative. And I made a comment that the Association of American Individual Investors, the bearishness was almost unparalleled. I think 61%, the previous week, the survey had shown that 61% of individual investors in the US were negative, okay, and thought that the outlook for the next 6 months was down. And that's only happened 4 times since 1995. Okay, out of 1,428 weeks, and that's the individual investors. Now, then, in the September Bank of America Fund Manager Survey, they go and survey fund managers, not individual investors, and there were 371 panelists, one covering $1.1 trillion. Okay, they had the highest cash levels in 21 years, and the most crowded trade was long US dollar and short Europe. Everyone was underweight Europe. Okay. Now, since the end of September, which is pretty much when we spoke, North America is up 10. The world index is up 11.7. Europe in dollars is up 19%. And the euro is up 6 and the yen's up 3.8. And we spoke at the time, and I think I said, listen, if you can't invest now, you should actually find something else to do.
Yeah.
And you can see, so you have to make the difficult decisions, and if you can do that, and if you can stay the course, and of course, by all means, invest yourself, but maybe not invest all of your money yourself, but you can just see that if you get the timing right and you go against the crowd at the right time, it can be very profitable.
I think this is becoming the penny's dropping with people now. It's great to invest in your own equities, but really give the experts some of your funds as well. Yeah. At least 50%, I think, would be the right thing, because you scheme all day about investing. Those of us who maybe invest on their own shares and on your recommendations, think about it once a month or so. So clearly, there's a nice balance to be. If you're going to do your own investing, although many people like Jeanette, she's in the other camp. She says rather give the money over to somebody like Sean or like Sai or like Pete Fillion, and let me employ them, because I don't charge a heck of a lot either.
Yeah, but it's like watching tennis and playing tennis. You want to participate, and it deepens your understanding. And I think the benefit of doing some of that yourself is you can see what mistakes you make, and then make sure that you find a fund manager who doesn't fall into those traps, maybe. So,
Sean,
yeah.
There were results out today from 91, and I know it's not really politic to talk about your competitors, so we're going to leave that side out of it. But the thing that struck me was this is to the end of September. 91 has got 132 billion pounds under management, but that's down by 230 billion rand. 230 billion rand in the last 6 months. 8%, I think, is the number. Their profits are down 16%. So it seems that in your game, the profits are made by companies on the amount of assets they have under management. And we've spoken about this with performance fees and et cetera, et cetera. But does it surprise you that these numbers come out from 91, net outflows of billions of pounds now that they are reporting? And is that a trend that one's seeing?
Well, Alec, I haven't looked at those accounts, so I can't speak to 91. But it's certainly, your bonds are down, and so if you had $100 invested as an asset manager at the beginning of the year, and you are weighted towards growth and quality, which are down 26% and down 21% or whatever, immediately you're taking a 20-something% hit. If it's all equities. Now, typically what's happened in the past is many of the large asset managers also have a big weighting in bonds. And so if equities go down, bonds go up, and it sort of, balances each other off. What's happened this year is bonds have fallen and equities have fallen. And so you really are seeing assets under management fall just because of the value of, just the prices are falling. And then if you couple that with outflows, because people have been nervous and about wars and recessions and things like that, you can see how assets have fallen a lot, and these are highly profitable businesses, and so assets fall, the impact goes straight to the bottom line.
It is also very interesting to outsiders, though, when you look in and you see Ranmore Fund Management, for instance, as you've said, you're in the top 1 percentile, and that, for people who don't understand percentiles, that means if if you had 100 fund managers, you would be number one because you'd be in the 1%. So you one out of 100 leading the pack. You won't get that from big funds. Warren Buffett says that size is an anchor to growth, etc. Now, we've had this conversation before. Are you still sticking to that principle that once you get to a certain level, you actually stop taking in more money because it's more difficult to get performance?
Yeah, definitely. I mean, absolutely. And I've got a pledge. It's public. It's on our website. And obviously, it's a million miles away from where we are. But it is one of the benefits that if you're small and you're nimble and you can take advantage of some of the smaller companies. I'll give you a perfect example. We bought a UK retailer here called Halfords. In the midst of the crisis when Liz Truss was with all that chaos going on and bonds are falling and the currency's falling, and you go, well, hang on, these guys are quite defensive. You have to get your car MOT'd, etc. We thought we were buying it at 4.5 times earnings. We could buy a meaningful position, and the stock, I think that stock's up 25-30% or whatever since then. And you can move the needle. But if you're a massive asset manager with hundreds of billions under management, you can't buy Halfords. It's a 400 million pound company. Even ABF, which I think you guys have bought, and I think you timed it quite nice. Did you not? Oh dear.
I know. I need my butt kicked. Okay. Yeah, you told us ABF. There is a South African connection through Illovo Sugar.
Yes.
Talking about Associated British Foods, yes. And we didn't buy it. Okay. But it's one of your favorite stocks. And
yeah, it's one of our top holdings. It's been doing amazingly and they had great results, and they announced a buyback, and it's up quite sharply. But that's a 10 billion pound company, and half of it's owned by the Western family. So you've got 5 billion pounds of tradable equity, and it trades, I don't know, 1 to 1.5 million shares a day. So it's a 14 million pounds, let's say, a day of trade. If you're running $100 billion, it's going to take you a long time to build up a position in ABF, and yet it's a 10 billion pound company. So, so I think size is a big factor. And
okay, so let's look back on the last month. You did say that lovely quote about if you're not going to buy Europe now, well, you perhaps should be looking for something else to do if you're a fund manager. You have been investing in Europe. It has done well. Is it still a time to be loading up on European stocks? And if so, what kind of stocks?
Yeah, look, we have more than 50% in Europe now, which is very overweight, okay? And it's just because that's where we find the value. And if you look what's happened in recent months, we can see every day Putin is pulling back, and this war, he's losing the war. It's been mild. This weekend, I think we had 19 degrees in the UK here. So gas storage is full and electricity prices are falling. And maybe we don't have as deep a recession as elsewhere. These tech layoffs that you're all reading about in the US on a daily basis, I would think that a lot of those are taking place in the US. And so I find Europe very attractive, and we've got lots of companies on 5, 6, 7 times earnings, 9% dividend yields, and these are well-known businesses that are not going out of business, and so I find them very attractive.
Those are better than the lucky sevens that John Biccard was talking about in South Africa. Just explain that again. Because he said the lucky sevens were 7 price earnings. In other words, get your money back in 7 years, 7% dividend yields. And he said 20 years ago, he made a lot of money for his investors by buying those. It sounds even better.
Yeah, and I quite enjoyed that, actually. I did hear that interview, and I thought John made a good point. But I mean, you look at some of these European banks, Alec, they are on nice, attractive dividend yields. They're overcapitalized. They're selling at half book value. And places like Ireland are Brexit beneficiaries. They've got the governments are getting tax revenue from these tech companies paying their pandemic profits. The economy is booming. They're well capitalized and they're cheap. So, so I like European financials, mainly banks.
When you say European financials, Ireland obviously part because it is part of the EU. Are there any particular banks that or any particular stocks that stand out to you?
Well, the Dutch banks, ABN AMRO, I think is a good one. And they had good numbers, and it's well capitalized, and great core T1 capital ratio, and selling at half book value, thereabouts.
Wow. Yeah. Corky would be salivating.
Corky I'm sure Corky, I hope Corky would like it, because, I have great respect for Corky. So do ask him about ABN AMRO next time you speak to him, Alec.
I will indeed. I know he liked, I think it was ING. He quite
Same
likes them
thing,
as well.
pretty much. Yeah.
And from the Irish perspective, you did mention Ireland. Are there banks there that aren't too high risk and worth
Yeah,
looking at?
there's AIB. I mean, one of the risks is that the government owns a big stake in the bank, and so there's always that overhang risk. But that's okay. But I think I'm right in saying a little while ago, if you added up the market cap of the two Irish banks, it's mainly Bank of Ireland and Allied Irish. Okay, the value was less than what Adobe paid for Figma, which none of us had even heard of. Okay, it's quite
Wow,
a
that
thought.
puts it in perspective.
Yeah.
While we're talking about the global markets, this past week has also seen some interesting moves on the crypto side. This FTX, Bahamas-based, seemingly unregulated Bitcoin exchange run by a crazy 30-year-old that everybody now knows is one of President Biden's biggest supporters. And of course, there's all kinds of conspiracy theories that go along with that. But it continues to amaze me that you can have this kind of a wipeout in this day and age.
Yeah, I think, Alec, I actually wrote a LinkedIn post. I'd never even heard of this business, and I'd never heard of Sam Bankman-Fried, and I must have been living under a rock. But it just shows we have been led down the path, because what was the story with crypto? Oh, you can't. It's the only currency not controlled by central banks, and it's against fiat and all this conspiracy nonsense. And what have we actually found out? There have been so many hacks and scams, and people have lost so many billions of dollars. We've actually found that, maybe it's not a bad thing to have your money controlled by central banks, because it seems to have been controlled by scam artists, if you think about it. I mean, there's even a thing called crypto jacking, hijacking, crypto jacking. So it is just go online, Google scam, crypto frauds, crypto scams. The list just gets longer by the day. And I've been very negative and quite outspoken about it, and on LinkedIn, and received quite a lot of, comment on some of that stuff. But I think people should just stay away from that. And if you're not sure, there's listen to Charlie Munger and listen to Warren Buffett and what they had to say. They were quite derisory, and I think it's people are going to end up losing everything. I'm pretty certain of that, to be honest. That would be my view.
Interesting point of view. The views that we've kind of the consensus view of, if you like, our BizNews trusted advisors is to have no more than 2% of your portfolio. Have an interest, but don't go mad on it. And maybe just to kind of finish off, we always wait for this, for the end of the market, the bottoming out of the market, the time that everyone thinks stocks are never going to go up again. But there's always another shoe that seems to be dropping somewhere. Is there another shoe in your crystal ball?
Yeah, I think there is, Alec, and I think it's going to surprise people, but I think high quality companies are the next shoe to drop. And some of them are tech, but not all of them are tech. And let me give you a reason why. Let's give you a perfect example. I was thinking about this last night, knowing we were going to chat. Let's say you've got an amazing business and it makes $50 of profit. Okay, but you only needed $100 to make that $50 of profit. So your return on equity is 50%. And I come along to you and I say, Alec, I want to buy your business from you. And I'll pay you 20 times earnings. So your earnings are 50 and I'm paying 20 times. So I buy it for 1,000. All right. And on day one of me having acquired it, it's cost me 1,000. I've paid you 10 times your book value. I'm still only going to make 50. But it's cost me 1,000 to get that 50. Okay. So my return on equity is 5%. But it's the same business. And so the point people miss, and so I've taken a great business, but by overpaying for it, I'm not going to get a low return. Who wants a 5% return? Okay, in this day and age with inflation higher. And if you actually have a look at that, Microsoft made 70 billion of profit last year. Its equity is 166 billion, 42% return on equity. Great business, a moat, etc. But we're not buying it for 166 billion. If you want to buy it today, you have to pay 1.8 trillion. And so that means you're getting a 3.9% return. And who wants a 3.9% return? You only want a 3.9% return. That's assuming you get it all in dividends, which you don't. You only want a 3.9% return if you can only get 0% in bonds or negative return in bonds, or it's going to grow a lot. But Microsoft only grew earnings 3.7% last quarter, and buybacks gave it 1% of that. So it's not growing. Everybody owns it. You're only getting a 4% return, and bonds are now giving you that. So this is the next shoe to drop, I'm convinced. And everybody owns it. So I think there are not enough lifeboats. When people figure out that they're paying 26 times for Pepsi and 33 times for Estee Lauder with revenue down 11% last quarter and EPS down 28%, I think everyone's going to go and say, well, these are great businesses, sure, but Microsoft's down 27% this year. So great business doesn't mean that you're immune from getting hurt in terms of the value. Great businesses, share prices fall for great businesses, as they have done for Microsoft, one of the greatest, but you can't pay too much. And that's the thing. And that's the next shoe I think that's going to drop, because everybody is in them.
And have a look at what your return on equity is, not the company's return on equity.
Correct. Yeah.
Sean Peche from Ranmore Funds. As always, it's fascinating getting your insights. Thank you. I'm Alec Hogg from BizNews.com.